And Donald, that has to take place before the IDA is obligated to pay its first million.
That's the end of this year?
End of this year, yes, sir.
Okay, I thought the other day it was like they would start getting money by July.
It was, the dates did move out, Donald. I think that, I don't remember what it was, a September bill initially.
This is,
first discussion.
this is more of a default date. They still have the October. It's not, it is a date not before, but then a date not after.
Let me reset, let me rephrase.
Yeah, I wish you would. Please.
The way it's set up is they have until December 31st to demonstrate two things: the job creation and the outside money, $3 million. But it's an on or before issue. They can do it anytime up to,
Right.
It's a backstop of December 31st.
Right.
The obligation of the IDA to pay the $1 million is not any time earlier than October, so that you're in a new fiscal year.
Is that in here?
Yes, that's in paragraph 8 under the IDA's section.
Oh, 8? Okay, we did that.
That's what Bill meant with whatever it was he said. I can't even repeat it. But, not before, but later than after, or whatever he said. But,
Could you explain for me, please, the limited to loans, sales, contributions, and contract revenues? It's not just money? How do we,
It is money, but it's money from whatever source is the intent. Whether
Okay.
it's sales revenues, whether it's loan proceeds, whatever it is dollars. That is the intent there.
but a loan has to be paid back, correct? With interest. So is the job self-sustaining from the product that's supposed to generate the company? Or, you know, when a company lives on strictly public money, shouldn't the public be protected to be assured that the money, the product that is, that the company sells is enough to sustain that job? Because after the public money runs out, then the job can't any longer be there because it's not self-sustaining from the product that they sell.
I don't know if the board wants to debate that. If you want to exclude loans from that, that's a board issue. The thought process, Horst, was that it demonstrated some third party has been through the financials and felt comfortable that they have the ability to repay it.
Where?
Okay, how are they gonna prove sales if we don't have that information?
They start to have.
Don't have to prove it to us?
That's
Okay, well, that's good.
What they have to prove to us is they've put $3 million in the company. If they borrowed the money from you, they take that money, put it in the company. We have clawbacks, if you want to use that term, that we've heard multiple, massively amount of times, in this contract that speak to that issue if they default.
Okay.
So when we get there, I think maybe it'll be a little clearer, I hope.
I hope so too.
Didn't we, last time when this was talked about, wasn't there something about 5 million from a venture capitalist or something? That they were gonna go after and prove, and have to prove they got that money before we went with this?
Right, but it's split up two different ways, 3 million, and we give them $1 million.
I know, but I
and then
don't
2
see
million
anything in
before we
here
give them the
about-
second million.
Yeah, okay, but I don't see anything in here about that, because I asked them to bring the check here and put it down here, then we'd give them the check for the $1 million, and that seems to go
think
out.
it's-
Is that going out the window?
No, sir, it's proving up the external financial contributions, investments, whatever terminology you want to assign to it. It's Clifton Larson Allen being satisfied through agreed upon procedures that you're going to look at before you guys are asked to vote on this issue, that they have sufficient evidence that money came from somewhere outside the project. It's external money, it's not IDA money from the previous, it's not, whether it's Travis Bond personally, whether it's wherever it comes from, it's external money, external to the IDA. And it's not IDA money.
Well, what I look at is that we'll have $9 million in this. And if the product is good, then they shouldn't have any problem getting a venture capitalist or a loan from somebody. But if they can't get that, then that tells me there's no demand for this product. And we're just pumping money into something that nobody on Wall Street or anywhere wants to be a part of. They don't want to stick money in this thing. And if you get a venture capitalist or a large bank to start dumping money and helping these people, then they're on board that this is a good product and it's going to go. That would make me feel better. That outside people have say, hey, this is going to work. This is going to happen. But when the outside people doesn't after 3 years, then it looks to me like we're just throwing good money after bad.
We're not spending any money if they don't come up with that capital. No.
They have to come up with it first.
They gotta come up with the first 3
But-
million
but-
for
but-
us to give them $1 million.
Well, I understand that, and I'm trying to, I mean, when it says in here about loans, sales, contributions, contract revenues, that's things that we're not gonna be privy to because it's confidential information according to them. How are we gonna know?
Clifton Larson Allen is going to certify to you that they have been satisfied through the agreed upon procedures you approve in this contract, that they have looked at records that demonstrated that, sufficient to convince them that that in fact occurred. And I do believe over the next several months that there is going to be information released to you as to who some of these investors are. I don't believe.
The burden is on them to prove that they have put the money in, and then Clifton Larson Allen has to verify it and present it to you before you have to put any more money in.
Okay.
But clarification point, they can do that by way of sales, a loan, or whatever. If they have a company that all of a sudden has 100,000 members that's going to use their product, and it means that they will have $3 million worth of income from that, that justifies us giving them $1 million.
That is correct.
Well, at what point do we, if they say in the next year, they've made $20 million, why would we need to give them anything?
Maybe you don't.
Well, it's not in there that we
I
don't.
mean, if by October or November, they've demonstrated, 20 million there, the only thing is, Donald, I don't believe if they enjoy that kind of success,
Well, I hope they
there's a
do.
disincentive for them to take it because of the repayment obligation. If their intent was to have that kind of success, and if they move the company, sell the company, don't leave the jobs in Hardy County, they have an obligation to repay. It's addressed in 7.1. And I think that, why would you borrow money if you had $20 million in revenues between now and
But-
September, October? Why would you basically come in here and say,
That's green.
let's take another $1 million from the IDA that we're gonna have to pay back?
Well, if you have to pay it back, but this is an agreement, if they put in $20 million, we're obligated to give them $1 million. Now, whether or not they want it or take it, but according to this agreement, we're obligated to give it to them, because it's an agreement. And so Donald's right, if they do $20 million and they come to us for $1 million, we've got to give it to them. Now, will they do that? I don't know.
But if
So
my
so the
understanding was
question-
Travis talking the other day, they can't wrap up that fast and get enough people in place and do the
Right.
jobs fast enough to get $20 million right
That's,
now.
that's probably,
But if they
That's why
did,
over
that's
a
probably
period.
true.
But if they did, yeah.
we're obligated.
But
to
I
let
don't
them
think
know.
he thinks they can get everything wrapped up
They
that
could.
fast.
They could.
I mean, that's why they've been to the college. They want programs in place to get people here qualified for their jobs.
I agree.
You could, I mean, it's up to the board. If you want to make an attempt at a provision that sets a threshold somehow on the high end that says if all of those dollars at the time of IDA contribution exceed a certain threshold, then you're not obligated. We can talk about that. That's why we're talking about this, for you guys to consider and make.
I guess
suggestions.
in a contract like this, that there's no provision you can put in there that says this contract can be brought back at any time for review or anything.
Problem with that, Donald, is that the venture capitalist investor types that are looking at this thing want to know what's there, they through their due diligence, look at the project, where it is, the product, where it is, the marketing efforts, and they in their best mind try to figure out how much money this company's gotta have to really get this thing to where it needs to be. And they look at the contract, and then some way, what they put into it is reliant on what is committed to here. And so if you have a back out provision, or at any time you could just walk away, I don't think they'll get the first dollar of private investor money. Maybe I might be wrong, but.
Yeah, all right.
One other point is, I have no idea how the venture capital money is structured. No one in this circumstance they're not gonna enter into an agreement with a company without some type of financial instrument. Even we have a financial instrument. So if you get into the semantics of calling it a contribution or a loan, or is it a contract? I mean, we've tried to identify all the possible ways that money came in. I've never really contemplated the specificity of how the money came in.
I think the other consideration for the board to think about on Donald's point, which is a good point and good question, is this: if they had $20 million in revenue by the end of this year, the job creation is going to be astronomical, I would think. I mean, if you have that many contracts that you're generating that kind of revenue, you have to service it. And so, whether it's serviced through multiple shifts, and there's 3 to 8 hour shifts going through the building out there, or what's happening, there would have to be job creation that's somewhat commensurate with the revenue that's being generated. That's the return I would think that this board would like to see in terms of your ultimate objective has been job creation anyway. So.
Thank you.
Ken, Scott Tappan is here, and Scott has been kind of a mediator between Continuum and venture capitalist folks. Scott, can you address some of these points for a moment, please? Certainly.
Good morning. Question specifically is how the money, what type of money?
How it comes into the company from a categorical standpoint, and what limitations that, if we place them, how does it impact the willingness of venture capitalists to make contribution in whatever form they make?
Sure. Well, I think Ken and you both hit on it. Any type of investor is going to want some type of certainty. Otherwise, they discount what's there. The groups that we have been talking to has been a partnership with, as Bill alluded, or Ken alluded to, they have evaluated the product, and they take our projections and basically do their own due diligence on marketing, the staff, our ability to raise money, our ability to be able to bring people into the jobs and project what the cash flow is going to need to be. Trouble is, we don't know for certain where this thing is going to project, how fast it's going to ramp up. I'll tell you, if you're talking revenue dollars, if we do project a hockey stick type, there's a lot of investment in infrastructure and training and people. The company may sell $10 million. They may not make any money in a period of time. I mean, we really are looking at probably about 18 months to be cash flow positive if our projections happen. If it's steeper, if we bring more people on faster, as strange as it sounds, that may be pushed out. And that's part of the sensitivity analysis that an investor will do, is to actually look at where they think the money needs to go to be successful. So in the attempt to not limit other investors, some bring equity debt where you actually own part of the company. Some do it as a note or a loan that's convertible. Some may just give, expertise. So we're trying to be in general about what the funds come from, but specific enough that Clifton Larson Allen can look at it and say, that is capital cash that's come into the operation of the business, which my understanding was, for the pleasure of the board, to show some outside acceptance and due diligence of the product and the project actually had, a way to succeed.
Well, I have a question, please, for this gentleman. Is it a possibility, and based on the product, and it turns out to be a really, really good product, and you need 1,000 employees, is it a possibility that the company would just simply say, we can't afford to stay in Hardy County, we must move in order to increase our workforce more efficiently?
I mean, I'm an engineer by training, so is it a possibility? Yes. Is it a probability? I don't think so. I mean, I think we're here for more than just the money. I think the economics and the willingness of the community to work with us to put people in the seats in Tech River is of great benefit. I don't know that anybody would argue that you're not going to find 1,000 people here in a short period of time. I mean, you may be able to pull them in. I haven't looked at demographics to know what the ultimate capacity of the surrounding counties are. I think worst case, you end up with a very world-class operation here that probably grows to the maximum that it's capable of growing, right? And then you may have some type of outside extraneous support, but I think the first mission is here. I just don't know what those numbers are.
I'm an engineer too, thank you very much.
You're welcome.
Thank you.
All right, thank you.
Okay, we'll move on. Letter E, bumps it up to 40 full-time equivalent positions located in Hardy County no later than May 1st of 2015. F ties, it's the same issue in both I mean, you guys have talked a lot about jobs, and you've talked about how we prove up self-funding of operations, and then F and E and F are kind of the same issues, but on a next year time frame. Still job creation, and it's still outside money, another $2 million of outside money before you're obligated to pay your second.
Shouldn't that read an additional $2 million?
Above the 3 you're talking about.
Yeah.
Yeah.
Yeah, really not clear.
Good point.
I understand it.
Okay, letter G, they're gonna come make quarterly updates to the IDA, no less than quarterly, it says. Because this is not being on a monthly draw schedule like the prior things, the thought was quarterly, probably insufficient. H,
Wouldn't it be also good to have jobs in there too on the G? Status on
weekend
jobs.
status on marketing efforts, sales, and job creation. Okay.
We can have theirs, but I don't think we can have the agreed to procedure certified job. We can have a presentation from them.
That's what this is, in G.
Yes. But it's not gonna be certified.
No, it
It's
won't be
not-
certified.
When will it be certified?
Well, this is just in reference to the quarterly meetings
Right.
or other meetings. If they just come and give us some benchmark presentations for the company. The certification will occur according to the dates, but the initial draw request will be made when the company says to us, we have met the outside contribution and have met the payroll. We would like to proceed with an agreed to procedure certification by Clifton Larson Allen. Is that clear?
Letter H and I and J.
With Ken, with, they're in H. To keep anybody from questioning anything, can we add maybe like the chairperson also to go along with the administrator? So nobody can ever question, well, he looked at it, nobody else did.
Nobody would do that.
I mean, I think it would just kind of protect everybody involved.
That's fine.
Also, what is a reasonable time period?
Guess it depends on the circumstance. I mean, if it happens to be a holiday weekend, or if it happens to be a holiday, you know, if you call on Wednesday afternoon before Thanksgiving, reasonable time frame would probably not be before Monday following. I'm not being smart. I'm just saying it really depends. That's why lawyers always use terms like reasonable, because someone can be on vacation. Well, the person that holds those records are on vacation, Bill. They're out of country for 10 days. Can you come back on day 11, or can you, whatever? It's subject to whatever the prevailing circumstances on the ground.
Well,
are.
as long as a reasonable time period is not 3 or 4 or 5 months.
Well, I think 3, 4, 5 months is not reasonable in
Well,
anybody's.
that's right, but it doesn't, okay, all right.
And I'm going to tell you that, just so you guys understand, most likely I and Jay are probably going to be tweaked some, because we stuck these in here just to have basically a placeholder type provision. What we're looking for is the Exhibit A from Clifton Larson Allen on the agreed upon procedure, so we can specifically identify what records will be looked at. So this little 2 or 3 paragraphs right here, I'm telling you right now, expect to see something different when you get the final copy of this thing, because it kind of depends on what it is that Clifton Larson Allen has come up with to say, we're going to specifically look at these documents. So don't be surprised when you see this thing before the next meeting and say, will you change these on us? Because I'm telling you now, I expect them to change.
One other point along that, I don't know that we've discussed it yet, but there are really 2 different sets of documents that have to be looked at. The first set involves the outside money and the creation of job performance relative to getting the additional $2 million from us into $1 million and $1 million. Thereafter, it involves another section we're going to get into, proving up what type of retirement of their obligations or deliverables occurs within the contract. We'll cover that in a minute, but I want you to remember that there really are 2 different criteria for agreed upon procedures in this document. Do you follow me there? First one is to get the $1 million and then the other $1 million. That is a little different set of documentation relative to retiring the debt with job creation that will be forthcoming as we discuss the document.
Okay.
I'd like to kind of second Gene's comment there a while ago. I think, Bill, as many times as you can, to try to get one of the members of the board, whether it's a chairman, vice chairman, or whoever.
Can't hear back here.
I just wanted to second Gene on his comment about having another member of the board in on a lot of the discussions. Just as far as beneficial to your job and our jobs, to have somebody else there just to do it. I know we're not going to be able to talk to them, discuss it until we get into a meeting like this. But from the standpoint of, well, just like the, what was it there on, the one about the, on B and the Tech River, the rent, you know, maybe we have one of our real estate members involved in that, just to, you know, kind of know what the local economy is and what the rental property's bringing and that kind of stuff. And like the other day, you met with the investors, correct, on this program? You know, I think that would have been a great idea to have Vanessa there or something else like that, you know, get pressure off of you and us, okay?
I concur, and I do that. I don't do it every time because sometimes the meeting structure just doesn't work, but I concur and support whatever language you want to put there. I'm good with it.
Well, I know you've called me on one or two and all, and I think I should need to operate like that as much as we can. I mean, this is a voluntary deal, and we all put a lot of time and effort into it, but I think it's something that the community would appreciate.
So noted. Letter K, moving us along, is just the paragraph where it says the agreed upon procedures are going to occur on the job creation and the external contributions before you have an obligation to fund. L is really where it says they're going to continue to develop and market the CareSync product and other web-based technology and services. And we added that phrase on the tail end of it because if they were to expand or do something different, it actually allows for growth of the company as far as whatever direction they end up going, which may be years out from right now or years out from the time you fund. M requires that they use commercially reasonable efforts to cooperate with the IDA. Donald, no, I don't really know what that means. Commercially reasonable efforts is a term you see often in contracts that they can't guarantee anything, but they're going to attempt to help the IDA increase occupancy in the building, other companies, to fill vacant space in the building. N talks about the Exhibit B note that's attached. 7.1 is where we get into clawbacks, as Jim talked about, and tell you the overall explanation may help you understand as we go through. The idea here is that in the event, 7.1A and 7.1B, the next couple pages, the thought process with this whole section, 7.1, is that in the event they were to be highly successful, flip the company, Google comes in and says, we want to buy you 2 years from now for $150 million or something, that the IDA is going to recover what it's got in it from day one. Now, it doesn't include Preco building improvements. The 9.25 is grant money. 7.1A is an attempt to describe the method by which they can, the word Bill used is retire, I'll use the word reduce or satisfy the repayment obligation, basically by the length of time they stay here and the total payroll they've paid in Hardy County jobs. And so the language is there, but let me just try to explain the way 7.1A reads in plain explanation. If they stay 5 years, I'm going to add at the suggestion of one person who spoke to me already this morning that we put a mathematical example in 7.A to demonstrate the application of this thing so that it becomes more clear. So that I've already noted to do. But if they stay here 5 years and they were to create 150 jobs, what we're saying in that chart is that you take the gross payroll dollars that they've put in on an annual basis that will be certified annually. You add up those dollars. So if those payroll dollars, if 150 jobs created a $2 million a year payroll figure, gross payroll figure for Hardy County jobs, they're gonna get credit, so to speak, for the number that is assigned over here is 200%. So the attempt is to try to incentivize them to create more jobs than the 40 by ramping the number up to 200%. You're allowing them to retire the obligation faster. So an example might be if they had a $2 million payroll and they're here and in year 5, they're attempting to sell the company, do whatever, they may have no repayment obligation if they have 150 jobs. It's 150 jobs, they would get 200%, which would be $2 million payroll, which would be $4 million a year in credit, which would mean in 2.5 years they would retire their at that level of employment. So if they sold the company, flipped the company, whatever, there would be no obligation to pay back the IDA at that number of employees after what, roughly 2.5 years on a $2 million a year gross payroll figure.
Okay,
Does that?
but you're assuming that whoever they sell it to is gonna keep it in the county.
No, at that point, Donald, the way we've prepared this is it doesn't matter if they have had that many jobs at that payroll. At year 5, it would be gone. And no one would owe the IDA anything. They could leave after 5 years, you just have to do the math. 100% is the easiest example. Assume they had 49 jobs for 5 years, and they had $1 million a year payroll. They get at year 5, they would have a $5 million credit, and they would still owe $4.25 million to the IDA if they sold the company, sold out, or the jobs were moved elsewhere.
Okay, so what you're saying is, if that happens, we have spent $9.2 million over these number of years and not really created anything. Because those jobs are gonna go away as soon as they sell out and leave. And we've spent $9 million on something that's just gonna go away, which we could have put it in manufacturing or something, and probably created a lot of jobs that's gonna be here for 40 years or 50 years or something.
This is here for the board to discuss. I mean, the little chart was an attempt to create a visual for you to be able to look at. The percentages are just something that we're.
Well, it seems like to me what you're creating here is an incentive for them to get it built to that point and sell it and get out of Dodge, and leaving us with 150 plus people without a job. And we haven't really gained anything for $9 million that's gonna be here for a long period of time. That's my fear.
I
So
think the
basically
multi-
what you're saying, Donald, they need to have a penalty if they leave. And can you legally do that?
Well, I think we can. I know that
Or
Bill's
even do away
thought-
with this chart.
Bill's thought process was that when you get to something like 150 jobs, the multiplier effect on an annual basis of that kind of payroll, you are getting something for your money. It's not like after a 5-year period of 150 jobs that you've had nothing.
If
But-
they stay.
Yeah, if it
If they
stays.
stay. The problem is the math is 150 jobs at 35,000 is 5,250,000 a year at 200%. That means in less than a year, their obligation's done. Now, I would like to think if somebody comes in and buys them, and there's 150 people working here, they bought them for the reason that they're happy with the success of the business, and the 150 employees would be part of the success. But anything can happen. I wouldn't think it would make good business sense to pack up and leave. However, at that point, the obligation's over.
It can be scaled however you would like. The intent was to incentivize them to get to higher numbers of jobs. That was
I
the,
understand.
And
that was
I
the
think we
intent.
all agree with that.
Right.
Yeah. I think we all agree with that.
We did work with these numbers, and they're flexible. I mean, it's not, they may not be the right numbers. We'll put a little more time and thought into them, but we had to have a starting point for discussion, and that's what we've provided you here today.
I think some of the concern would be, to me personally too, is to your point about, and others, that if we incentivize them so high, percentage-wise, that within a couple of years, assuming they're massively successful, and XYZ company comes in here and buys them out and says, well, we're moving to Nevada because of the tax ramification issues, you know, their obligation quickly is up with us, and we've created, for lack of a better word, temporary jobs for a couple of years. I like the concept personally that there would be some penalty, if you will, before a certain period of time, 5 years, or 3 years, 12 years, whatever, that if they move that company between now and then, no matter how, you know, profitable or how great they are, they gotta buy us out of it. I mean, and I know people don't like that. I like that.
I do.
I don't know if the guy who owns the company likes
Well,
that.
let's talk about what the time frame is. What, I mean, that, I'm hearing you. You guys lead the discussion into what that time frame is, because we could insert something that says,
Well, I'm gonna put
Notwithstanding
tongue
any
in
of this.
cheek, and I'm gonna say 20 years. Now, I know that's not reasonable. I know that's not reasonable. But you know, we looked at this thing as a long-term benefit to our community, to our county. And in 2 to 3 years, if their incentive is not to stay here, what benefit have we really gleaned from that other than some jobs? Yeah, and the ripple effect of those jobs, and we've seen, you know, what that's about. But I would like to hope, to your point, that if this company's highly successful and another company buys them out, they're highly successful because of what's going on within the company. Could they be successful someplace else? I mean, why would you uproot something like that and hire 150 people in Nevada, and I use that state, start over, and hope they got it, I mean, I don't know.
One suggestion I would make then is that we move this scale somehow completely, redo the scale on the multiplier over there. So it's, that's one way to address it. And then a provision that says, notwithstanding any of these calculations, the obligation is not retired or satisfied at any point earlier than. And
make it
plug
retroactive?
Plug a time frame in there, and then, Gene, that's a good observation. If you wanted to do that, then as long as they stayed here, whatever the minimum period was, you could go back and credit the, I don't know. This is for you. I can make it, I think I can do it however you guys want to do it.
I understand the premise of why you would want to give more percentages for higher jobs, but I don't know why 100% ever, above 100% would ever be, we should ever do more than that.
Maybe I can add a little color, because as we talked, it was either side of a target, right? It was a disincentive if you didn't, and an incentive if you did. And I totally understand where everybody's coming from. What I'm trying to do, and I'm not a mind reader, I'm trying to get an agreement that will be attractive to investors. Now, that's not saying, you know, there's anything right or wrong about this. Typically, an investor is going to want an out. He's going to want to know, because he doesn't know what's going to happen 1 year, 2 years, 10 years down the road. If there's an agreement in place, the longer the time, the more flexibility they're going to look for, because they just don't know what's going to happen. So what Ken tried to do, what we tried to do in this, was address the three possibilities that we saw. One, we were successful and nobody ever bought us and we stayed here. At some point in time, the agreement ends, how do we cash out? Two, a company comes in and uses the facility for a period of time, and how do they cash out? And three, a company comes in and uproots. Again, engineer, possibly somebody could come in and move it. Probably would not. My counter to that is, if you have established a workforce that's skilled in a customer service industry, that is a valuable entity to anybody that needs it processed. Now, possible, probable, I don't know. But we really were trying to put some finite terms around what an investor would look at and say, okay, I will take a risk on that. Because what they do is they have, hundreds or thousands of opportunities they look at a year, and they have to evaluate the risk associated with each one. And while I'm totally understand trying to make sure we put as much into this agreement as we can, I'm trying to balance it with what I think is reasonable on their end from an expectation standpoint. So I don't know if the numbers are right or wrong or not, but I don't know that I don't look at it as a potential failure. If you hire and train and give people skill sets, they'll be deployed even if it's not right here. If you have people in this county that are trained, that is a massively marketable skill set, whether it's 2 years or 3 years or 5 years down the road. I think they have a landing place. So that's how I slept at night when I looked at, could a company come in and pull everybody out? Sure. Do they have an education or an experience maybe different than what they did? I hope so. And I hope that the group is, is leverageable someplace else.
Well, you're trying to protect your investors, and we're trying to protect our citizens. So it's
I understand.
we'll find a medium place. But,
Yeah, and it's
this is not it.
Yeah, it's not so much trying to protect the investor, it's trying to make sure that we can be successful here. And I say we, meaning Continuum and Hardy County, because my three charges, right? I have to find money that will help support the company and grow so that we can have a need for a service center here. I've got to do, strategic business development so that we have partners that give us money that come here. And I'm responsible for making sure that center scales, is world-class, and that we have people that are here that can be deployed anywhere, right? What you want more than anything is you want people here that everybody in the country wants. Well, that means somebody from California is coming in and saying, man, you're great, come to me. Not that they're gonna go, but I've always tried, whenever I build a company, I don't want people that nobody else wants.
Right.
I want people
I agree.
that everybody wants. And I'm just trying to figure out what is the best first shot at going back at the folks that we're talking to right now with an agreement. Because all they have to look at and gauge what this next round looks like is what the last round looks like. So they're gonna benchmark what the new agreement looks like in risk or opportunity against what the old agreement looked like in risk and opportunity. I just don't want them to be, I want you to be protected. I want us to be able to put people out there. And in order to do that, we need cash. And that's kind of how I balance things.
So from the engineering standpoint, I take it that the company was brought in as a fledgling startup, is that correct?
The Continuum company?
No, the very first one.
One of my companies?
No, I'm
sorry.
talking about the very first one owned by Travis Bond.
I haven't known Travis his entire life. I know he started a number of companies. If you're
In other
talking,
words, he came in with a successful product in the
I think it was
beginning.
Grant and it was LifeSync, I think.
yeah, I know Travis has built some successful companies in the past and had some good exits. Yes, I know he built one from the ground up. I don't know about the rest of them. I think he's built a couple from the ground up.
What
what is
would
a
you
good
know,
exit?
Bill? Was it brought in as a fledgling
I
startup
think
company?
that's probably a fair assessment, but it was brought in with the understanding that Travis's business experience and acumen would be behind the scenes initially, and then when it moved from LifeSync to Continuum, Travis got in the pilot seat
Okay.
at year two.
What you just said there kind of concerns me. When you said that Travis has had a lot of successful exits,
I know of one.
and that's what concerns me about this, that it needs to be revamped. That maybe in his mind, that's what he's looking down the road for, is a successful exit. And I want to make sure that the Hardy County money is protected as much as possible.
No, I understand. And what you yeah, from an investor standpoint, I mean, there's a whole new dynamic once you bring investors in. You get a professional board, right? I mean, you don't just write a check to yourself and walk away. But when I'm talking about exit, there's different levels of exits. But to me, every time you have an exit, you have a liquidity event. Something happens. A company buys you, an investor invests. Somebody may come in and say, I've got a CEO that's 5 times better than Travis, and we're going to put Travis on the board, we're going to put a CEO in. I mean, there's all sorts of opportunities. if you build something here that's great, it will be worth something forever.
Yeah, I tell you, I'm not against somebody building a company and selling it, but it's the Hardee County people's money that I'm trying to look at right now,
Yep.
that we get the best bang for our
I
buck.
understand.
And I think when we talk about it, we also look at not only the company relocate, but when you got these people that are skilled in their positions, it's a lot easier sometimes to offer them a relocation package than it is go somewhere else and, hire a bunch of new people and start over from day
right.
one.
That's right.
Thus, not only have we lost our money, we've lost an important tax base in this county
Yep.
that have gone somewhere else. And I think from what everybody's talking, you can see that's our base, is try to keep as much of this here in town
Yeah.
and county as we can.
I understand.
Is it unreasonable, Ken, to like 5 years
Good idea, Jim.
with nothing and then retroactive?
That's for you guys to discuss. I mean, it's the reason we told you no one was gonna ask you to vote on this thing today, because these things had to be discussed and debated. This is a draft document. It still has, I think, cleanup that needs to be done. I haven't gone back and confirmed the cross references to provisions. We've worked on it, just about every day, I think, since the last board meeting.
Why don't we,
So-
before we continue on here, let's take about a 5-minute break. And,
I'm just fixing that.
yeah, let's take about 5-ish and we'll get back started again. Thank you.
When you get to be a senior citizen.
You're not wearing the pins, are you?